This week we're organising a pre-approval for a young couple to purchase a new owner-occupied home. Now, these guys are in a strong financial position and they qualify for finance with pretty much every bank on our panel. We could probably get them a rate as cheap as about 5.5, 5.55. However, the pre-approval we're doing has a rate of 5.94. Now you might wonder, why are we putting them in a more expensive loan for the pre-approval? The banks that offer the rates of 5.5, 5.55, they give them a purchasing power of about 1.8 million. The bank that we're applying to for the pre-approval has got a borrowing capacity or purchasing power of just over 2 million. Now, the market that they're looking in and the properties that they're looking for typically are selling for between 1.7 and $2 million. So if we got them a pre-approval for 1.8 with a major bank, for example, there'll be a lot of properties that end up just outside of their reach, and we'd be relying on the fact that maybe later we can get them a formal approval for this higher loan without that certainty, right? By doing it this way, we're in the pre-approval for the higher amount, the $2 million purchase, understanding that if they do find a place for less than $1.8 million, we can then go back and do the formal approval with the major bank and get them that cheaper rate of 5.5 to 5.55. So it's important to note that when you do a pre-approval, you're not necessarily stuck with a lender, you're not necessarily stuck with the structure that you apply for. And in fact, every time we do a pre-approval, when the clients buy a property, we then have a conversation with them to ensure that the product that we did the pre-approval for, the loan amount, the loan structure, and the lender are still suitable, especially if they've purchased a property significantly less than their pre-approval. We may have other options that we didn't initially consider who have lesser borrowing capacity but better features or better pricing. So good reminder that the pre-approval is really just a tool to allow you to enter the market confidently. It's not necessarily the loan you're going to end up with. Now, the one risk to this is that by doing this, it's quite likely there's going to be two hits to their credit file. Effectively, we do the pre-approval with Bank A with the higher borrowing capacity, they find a place for 1.7, then we do a second application with Bank B in order to get them that lower rate. So this is something that we're careful of if someone's credit file is perhaps borderline, and there's a risk that this is going to cause future problems. In this instance, these clients have got a very strong credit history, and there's effectively going to be no outcome to them. Dropping a credit score from 1,000 to 970 has no real impact on their lives. If you are looking at a pre-approval and your borrowing capacity is not quite where you want it to be, this is something that we could potentially do to help out.